Ladies and gentlemen, welcome back to the channel. What in the world's going on with AMC Stock? What do you need to know? This stock is down 3% today, whereas the Russell 2000 is up almost 1%. I think we need to talk. That's a simple fact. We need to talk what's going on with AMC Stock right now. There's a lot of fear out there that needs to be discussed. Is this justified fear? Is this not? What do I think about AMC Stock? It's $6.53 per share. We're also going to be going over everything that happened in our markets today and what the data is looking like tomorrow that could move our markets, potentially big time. Hit the like button and subscribe to the channel. And again, I do apologize for the audio. The audio is El Ducio because El Stupido forgot the mic. Okay, long way from home, and there's no store that sells one anywhere close to me. So El Stupido is the reason for this audio. Now, let's just go ahead and jump into it. So, what's going on here? Well, couple different things. So, the Russell is up about 0.72% today. So, almost 1%. And AMC is down pretty decently, about 3%. We don't have any specific AMC news that is causing this. No rhyme or reason to what is happening today specifically. So it's not like we can point the finger at something and say, yeah, that's just FUD, or, quantify or justify what's happening today with AMC. Now, 3% isn't crazy, right? We've seen much larger declines for AMC, but 3% when the Russell's up 1%, quite substantial. Now, by the time you guys see this video, the numbers could look different, but point is the same. AMC stock is massively underperforming. And we'll talk about AMC specifically, what I think about AMC right now, and what I think is coming next here in just a second. Let's go over a couple different things first. Carl, this guy is on CNBC. He's been on CNBC for like 24 years. I'm sure you guys know of him. Great account. You can follow him on X. He shares a lot of different things. Well, Harker says the economy is softening faster than the data suggest, with a little eye emoji. So what exactly does that mean? I mean, I don't know, but that just doesn't sound too fantastic, if I say so myself. And that just came out here today. You also have some troubling signs as well. Mortgage demand is really not picking up. We talked about this in the last video. It looks like really not at all. Mortgage demand actually slipped even more as interest rates did or have went from about 8% now down to 6.83%. Really not seeing any substantial pickup in mortgages. You're actually seeing things slowing down a little bit more. So that's not great. You also have FedEx that reported bad earnings last night. Not really a great sign for the consumer, and that just makes you wonder, why does the data look so good recently if the economy is slowing faster than what a lot of us expect? What's really going on? Unfortunately, we won't know until we do know, and hopefully what we find out is not terrible, because right now in this market, the biggest thing, the only thing, in my opinion, that's reasonable, that could justify the markets falling, is recession fears. Recession fears are like the kryptonite. Recession fears come back into our markets, we're going to have big problems, given where stocks are currently trading at. The indexes are at all-time highs. If you get recession fears now, oh boy, some heavy downside could be coming. I don't think that's going to happen in the near term, but as Fed Harkin suggests, maybe it's possible. So we definitely want to be watching that. A big data report will come out tomorrow that will give us a little bit more signs. And that data tomorrow, well, the calendar just jumped me to next week. The data that we will get tomorrow is going to be the GDP growth rate. Final numbers for Q3. We're expecting 5.2%. Let's say this number got revised down to 4%. I think that's way too low for the third revision. I think that's probably not going to happen. If anything, you probably come in at 5.2% or so. around the estimates, give or take. Maybe a little bit higher, maybe a little bit lower, but around this number. If we don't, that's going to be a big problem coming tomorrow. Any sign that the economy is weakening is going to be very much bad news. So that's a big one to be watching coming tomorrow. You will also get initial jobless claims at 8:30 in the morning, as well as Philadelphia Fed Manufacturing Index that also will come out at 8:30 in the morning. Continuing jobless claims, GDP sales, Philly Fed. You really want to watch prices paid and new orders. If those come in hotter than expectations, that probably will not be great. You will also get Philly Fed business conditions, Philly Fed capex index, and Philly Fed employment. Real consumer spending, CB leading index month over month, Kansas Fed composite index, Kansas Fed manufacturing index, and that's really it for your data. Those data reports are a little bit on the softer side, so your GDP number will definitely be the most important one for tomorrow and give the markets the largest move. Again, any weakness here in our markets is going to be seen as bad news for stocks. Now, tomorrow at 6:30 p.m., so after markets are closed, you're going to get the inflation rate out of Japan. Now, if the inflation rate comes in hot and there's worries that Japan will start raising rates, that's obviously going to be bad news as well for stocks. Just simply put, if Japan starts to raise rates, a lot of money could come out of our treasury market into the Japanese treasury market, and that could have a material impact in driving up 10-year treasuries. And right now, where we are in this marketplace, that just would not be what you want to see. Like I think stocks are justified where they are, as long as the economy does not turn down. I'm telling you right now, I'm pretty bullish on 2024. Pretty dang bullish. I think there's a lot of reasons we likely avoid a recession. I think there's a lot of reasons why the economy might actually accelerate in 2024. Think about gas going from $5, where I live in Michigan, down to $2.70 right now. That's a big savings that people are feeling. Everyone, whether you're low, middle, higher, income, that's thousands of dollars a year if you're the average driver. If you drive more than the average driver, that could be $4,000 or $5,000 you're saving a year just on gas alone. The average driver I work out drives about 12,000 miles a year. That's about 34 miles a day, roughly 2 gallons of gas. If you're saving about $2 and some change, call it $4.50 on gas a day, times 365 days a year, you're saving around $1,500 for the average driver. If you drive more than that, you're likely saving more. But that's extra money that you could save. I could make that argument. I could make the argument that it's very politically incentivized to not see a recession next year. They are doing everything they can to keep young T-Man from getting back into office. They're taking him off, the roster in Colorado. They're doing whatever the heck they can. The last thing you want is a recession in 2024. Like, you would rather anything else happen besides a recession, because the historical precedence is, if there's a recession when you are the president, you are to blame, and that is your problem, and you are not going to be reelected. It's only happened once in history, and that was in 1913 with William Taft, right? That he was reelected when there was a recession from 1910 to 1911, right? 2 years later, he was reelected. But any other time, it hasn't happened. So the historical precedents of a recession and elections are, well, you want to avoid a recession. Are not going to vote for you, right? They're going to say they're going to have someone to blame, and odds are it is going to be the government. So those are two big reasons. There's also other reasons as well, like we probably have been in a recession now for about 2 years, different areas, and I think maybe some people are starting to get to the point where they're used to living a certain way, used to cutting back, used to cutting back, and maybe they're just used to living now how they are, that maybe you don't see any continued slowdown from here unless people start to lose their jobs, so on and so forth. I just don't see a shock right now in the economy that's like gas, right? When gas went from $2 and some change to $5, that was a big shock to people. Now I think you're actually getting pressure off of the consumer. Also other deflationary pressures. Walmart CEO has talked about this, Target CEO, Dollar General, bunch of other retailers as well. If you really go to any stores, they're doing some pretty big discounts across the board, which hopefully that is helping some people save some money. And just so you guys know, from basically any recession we've ever seen in recent times, there's been a catalyst that caused it. So over the last 24 years, think about all the recessions we've had since the dot-com bubble, right? What happened with the dot-com bubble? Internet stocks went crazy for no justifiable reason. A lot of average people put their money into those stocks. You and me, average folks, they lost all of their money. Of course, you've seen a recession. 08, 09, mortgage crisis. They were giving out bad loans, right? Ninja loans, no income, no job, no asset loans. And that caused a recession. The Rona, that caused a recession. What causes it now? That's, I think, a big question that you need to think to yourself. Most recessions we've ever seen before have a central catalyst that caused them. I just don't see the catalyst as of right now. So those are reasons why I'm bullish for 2024. There's obviously more of them, but those are some of the big focal points. But according to Wall Street, there's still about a 44% chance of a recession in 2024. This, I think, is actually bullish because any time that you've seen a recession, typically it comes when nobody's really expecting it or not a lot of people are expecting it. Hence, you get some kind of catalyst that causes it. And right now, I mean, if you see a recession in 2024, it's going to be the most forecasted, the most predictive recession we have literally ever seen before. Yeah, just doesn't seem very likely in my personal opinion. But hey, crazier things have happened, so definitely want to be ready for that. Now, there's a lot more good things you could say here than bad things. Like last time we went from a 52-week low to a 52-week high for the Russell was 48 days. That was the fastest ever. The second fastest that we had seen was 60 days, and that was in August through October of 82. And the next year we gained 54% for small cap stocks that year. So small cap stocks are definitely going to be the winner for 2024. I don't really think I'm a genius saying that. I think that's more so common sense at this point, as long as we do avoid this recession. But really, it's not the recession that you need to watch for if you are an equity investor. It's recession fears. Recession fears are the thing that will really drive down stocks. Now, as far as retail leverage, open bull/bear positions, well, we still haven't stopped shorting. The S&P is 66% bearish and 34% bullish. The Dow is 78% bearish and 22% bullish. DAX, 81% bearish, 19% bullish. Gold, 61% bullish, 39% bearish. Oil, 83% bullish, 17% bearish. Risk off kind of trades, gold, oil, things that should benefit if, especially gold, if the economy does weaken from here, kind of that hedge mentality, doing better, seeing more inflows than outflows, seeing a higher percentage of people bullish than bearish. But the SPY, the Dow, the triple Qs, just not looking so good. This is a little bit less bearish than what we've seen before. But if you're using this as a contrarian indicator, this would suggest to me the markets could rally a lot more from here, because you just don't have everyone on board with, this rally so far. When everyone is on board with this rally, when everyone boards the ship, that's probably the time to get off the ship, because at that point the ship probably is going to start sinking, right? If your ship has a max capacity of 50 people, and 70 people are getting on, 71, 72, you better get off that ship and find a new one, because that ship is probably going to take on water at some point on its voyage. And that's kind of where we are right now. We're starting to fill the ship, but we're definitely not close to filled. If max capacity is 50, to use the same analogy, we're probably at like 30 right now. So there's probably quite a ways to go, just given the positioning we're seeing in the broader indexes. So I think that is bullish. And I do think, turning back to AMC, at some point, the situation will start to, affect AMC in a positive way. The capital coming back into the markets, as I project it will. will start to affect AMC in a positive way. You have $6.2 trillion in money market funds. You have probably another 4 or 5 trillion in cash on the sidelines. You have another, I would argue, 10 trillion that have recently went into 10-year treasuries that have bought 10, 20, 30-year treasuries and are positive on their actual value. What I mean by this, some people are a little bit confused on exactly what I mean by this. If you bought treasuries any lower than where TLT is, 99 and lower, you're positive on your notional value, your actual bond value, right? So there's probably $10 trillion worth, roughly, of individuals that have bought treasuries from, I would argue, September of 2022 until today, over a year, the last 14 months or so, that, you know, that's probably worth about $10 trillion. There's been a lot of money actually flow into treasuries recently. So that's a lot of cash on the sidelines as well that are just in a different instrument, that are in treasuries that could come back into our markets. And I think that ultimately is going to be bullish for AMC stock as well. I don't know when, I don't know how, I don't know what causes that. But right now, AMC stock is really underperforming the broader markets. AMC stock is down 3% today, whereas the Russell is up almost 1%. That is not exactly the greatest sign if you are bullish on AMC. That's why I've been saying for a while now, if you want to participate in this market, if you are all in AMC and you want to at least make sure that you will participate in 2024, think about diversifying your portfolio. That is not a bad thing. That is probably not a bad move at this point. I wouldn't sell my position in AMC by any means necessary, but to diversify a little bit, to buy some other stocks as well that should do, you know, 2-3x next year, potentially, a Fubo, a SoFi, a, you know, PayPal, a Tesla for that matter, that would make some sense to me as well. And I do think at this point, the reason why AMC stock is down 30% today, the reason why AMC is just sitting at multi-year lows, really can't do much of anything while other stocks are doing well, it's simple. Dilution. There's a lot of dilution fears. Everyone is fearing this next round of dilution that will come. Now, I will point out other stocks are doing pretty poorly as well. Fubo's down 3% today. SoFi is down 1.88%. Snapchat down 1%. PayPal is actually up 1.33%, so that's a good sign. Looks like PayPal might start to catch some upside momentum here. But yeah, I mean, it's really that dilution. We haven't got any word since the dilution came out if we're going to get more dilution, what AMC's plans are. AMC has been eerily quiet on anything that has to do with dilution or has to do with shareholder value. And that's a big problem when you have, you know, still 3x or so the float that could be sold, you know, onto the marketplace and really dilute your equity value of AMC. That's a problem. We need some kind of clarity, some kind of structure here. When we get structure is when AMC stock can rally big time. What you guys think down below in the comment section. Why is AMC stock underperforming? And are you buying more? Are you diversifying? What are you doing in your portfolios with AMC stock? So thank you for watching. Enjoy the rest of your day, and I will see you in the next one.